Thanks. We've made a little worksheet to show you how much you can save by investing in the lower cost funds. Okay, ETFs, there's a lot of them coming out. We've got a lot of older funds, which are a little bit higher cost because they were competing against mutual funds. So if you're paying 0.5% a year for an ETF, that sounded great if you're paying 1.5% on a mutual fund. But in today's world, there's been a lot more competition in the fund world in the making ETFs. So the ETFs are coming in at much lower cost bases. So you might ask yourself, how do I know I'm comparing apples to apples? Well, I found a couple free websites that can give you an idea. Typically, these funds use slightly different indexes, and the people who make the indexes, they charge a licensing fee. That's part of the cost difference. The other part of the cost difference is going to be advertising. You're paying for the advertising on CNBC and in your popular magazines and stuff, but from the big fund companies. Somebody has to pay for that. Okay, so the first one is a correlation, the price correlation over 6 months of two funds. If that's close to one, then it's kind of like you're getting the same thing. The second one is going to be a tool that just looks at what's in the funds. And you can see that it's pretty much the same. Since we're talking about cap-weighted indexes, they're, they're going to perform pretty much the same because most indexes are dominated by a handful of really big companies. Okay, so you might say to yourself, well, what are some reasons to invest in the high cost fund? Let's get that out of the way. If you're trading in and out, well, you're going to get better pricing on the high cost fund because usually they've been around for a longer time. It's what the traders like to use. It's just going to be better pricing. There's more trades going on. It's got higher volume. The second thing is that you might say, well, why don't I sell my high cost fund and go into a low cost fund? You have to think about the capital gains hit you're going to take. That's why a lot of these fund companies still have the high cost fund because they know people are locked in. And some of them have come out with low cost funds that actually compete against their high cost funds and other funds because they know people are trapped in the high cost funds because why pay all that capital gains tax to save some basis points? Okay, one company that's really out on the forefront of this is the Franklin Liberty funds. They have really low cost international ETFs. Okay, so that's where I got this comparison from. 0.49 is the cost of EWJ, the Popular Japan Fund. 0.09 or 9 basis points is the cost of the Franklin Liberty Japan Fund. They use a slightly different index. The correlation is 0.99. If you look at the holdings, they're pretty much the same. The Franklin Fund has a little bit more mid cap and small cap stocks in there. That's the only difference. So you say, well, what's the difference? Well, over a long period of time, it makes a difference. I've assumed a $30,000 initial investment and 8.5%. It's a little bit high, but you got to start someplace. A little bit high for Japan, yeah, uh, given the recent history. But Warren Buffett just started investing in Japan, so who knows? Things are looking up. Anyways, in 10 years, the difference is $2,542. If somebody gave you a post-dated check for that amount, would you cash it or would you throw it in the trash? I'd, I'd save it until I could cash it in 10 years. In 15 years, the difference is even more dramatic, $5,655. Seems like a lot of money. I don't know what I'm going to be able to buy in 15 years for that amount of money, but I don't know. Might be a nice family vacation, Might be one of those fancy electric bicycles. Might be a couple iPhones. Who knows? So anyways, that's something to think about. Thank you very much. You have a good day. Bye-bye.